Welcome back to The Money Puzzle. I am Chris Vaughn, along with my partner Eric Douglas here at Family Wealth Planning Partners. Thought we'd talk today, just a little conversation we were having earlier. It's all over the news about recession is coming and all that stuff, and everybody's panic and, you know, the sky is falling, the sky is falling. And Eric pointed out something. He said, why is that a bad thing? So, all right, I totally agree with you, but explain what you mean by it's not a bad thing.
Well, I don't want to say that it's not a bad thing in the moment. Sure. I'm not necessarily saying that they're fun or they're a good thing. But what I mean that when you look at just a natural economic cycle, mm-hmm. the evolution of the economy, the evolution of a business cycle in and of itself, a recession is a part of a healthy economy.
Correct.
Because things go up, they get to a saturation point, they need to come down to correct themselves. Mm-hmm. Typically what you see is an expansion of the business cycle or an expansion of the economy. So, you know, if we start here, right, on a curve, we go up on a curve. And let's say we go up to 10. Well, it goes up a little bit too high. You need a contraction, basically, in the business cycle. It's going to come down to, let's say, a 6. And then it's going to level out a little bit from there, and then it starts over again. The cycle resets. Over time, recessions are a natural, healthy part of the economy. I'm trying to remember the number of how many recessions have occurred in the last 100 years.
Oh, it's like 40 or 50 or something crazy. You don't even realize they're happening most of the time.
Exactly. And most of the, you know, obviously some are worse than others.
Sure.
And let's be clear. I mean, we're in a we're not officially in a recession until probably next week when the economic data comes out.
And we've had that discussion. By the time the data comes out and they say we're in a recession, turns out you're actually already out of it.
Or you might even already be recovering from it,
exactly.
Potentially, depending upon how bad it is. And certainly this is not one of the better ones.
Yeah.
But the market tends to be a leading indicator.
Well, okay, so let me go into something you just said, because I think, you know, you just pointed out there have been a lot of recessions in the last 100 years, most of which you don't have any memory of. What you remember 2008. You remember 2000, 2001. You certainly remember the 1970s, all of that, right? You think about things like the Great Depression, the big crash back in 29 and all of the 30s. Most recessions aren't like that. And, you know, to the point that we were talking about earlier, a recession is a good thing because it helps reset. Yeah. If you only had growth all the time, everything becomes overvalued. Now, I think that's one of the problems that's going on right now with the people that are a little panicked about their investments. You've had more than a decade of run-up. And the problem with that is, and COVID and the lockdowns accelerated this for a lot of different things, especially tech. Yeah. Things get more and more expensive. The value of those stocks goes up higher and higher and higher, and they're overinflated. They're selling for more than what they're worth. Yep. And you're thinking, oh, look at all the money I've made. Yeah, but you've made some of it, for lack of a better word, almost in an artificial way, an overinflated way. Mm-hmm. You have to bring that back down to make the market healthy. And sometimes that's just a little correction. Sometimes it's a recession. And to me, it's almost like, let's hurry up and get this over with. Let's rip this Band-Aid off. Let's have the recession actually happen, get it out there, and then we can move on.
Which is what we talked about a couple of weeks ago when we were analyzing kind of the first half of the year, when we were talking about market conditions, how the Fed is basically trying to raise rates to create a recession because they're trying to shorten the natural business cycle from maybe 7 or 10 years down to maybe 2 or 3, right. Because they want to basically hurry up, get the recession here so we can start recovering from the recession, because they're trying to, instead of postponing the inevitable, they're trying to hurry up and get the inevitable here as quickly as possible so they can start getting out of it a little bit more quickly. That's ultimately what they're trying to do. But recessions as a whole, they're an indication of a healthy economy. They suck when you're in them, but at the end of the day, you need to weed out the chaff, right? Separate the wheat from the chaff, right? So you need to, this is once again just a sign of a healthy economy. Yeah. You need it, and we think about 08, 09, and yes, if you were around in this business in that time frame, it was not fun. There was a lot of people that went through a lot of pain, and it was very much not a fun time, economically speaking. But we tend to put so much emphasis on what happened in 08 and 09 that we recovered from it just a couple years later.
Right.
And it spurred economic activity for the next decade that was unprecedented.
Yeah, great point. I mentioned a minute ago, for over a decade now, we've had this wonderful growth trend. But you have to say a lot of that was because of 08, 09, right? You don't have that great growth had you not had the reset to get everything corrected.
Yeah, I mean, we had banks that were lending out too much money to people that couldn't pay it back. They were getting, everyone was getting greedy with as much money as they were, taking out, because we had a very healthy economy at the time. It was overinflated to some degree, right? And people got a little greedy and it got put in check. Yeah. Well, it got put in check. You could even say maybe it deflated or over deflated. Yeah. However, I don't even know if that's a word or a term, but
over deflated. No, but
I
like it.
Now.
Let's
but
use
it
it
is now, right? So, but we recovered from it, and we had an extremely healthy economy for a decade. Yeah. And it was great. Well, all good things need to come to an end, or at least they need to come to a reset. Right. And even looking at the market as a whole, because so many, we're talking about the economy, and we kind of are relaying it back to the stock market a little bit here. But on average, in every 4-year history of the stock market, on average, you're going to have 3 up years and you're going to have 1 down. Right. What did we just have in 2019, 2020, and 2021?
If I'm not mistaken, the 3 greatest years ever.
The 3 highest consecutive years in the market, like ever. Right. Okay? We had the best 3 years in the market. We had an unprecedented, market run-up. Yeah. Okay? Well, that needs to reset. Taking away everything else that's happening in the economy, taking away what happened with COVID and the lockdowns and the economic stimulus and inflation, taking away all of that, we were probably going to have a negative year in the market regardless of any of that stuff occurring, because we were due. The economy just needed to naturally contract to some degree. Now we had some other things that occurred.
You got to have a catalyst that causes these things to get started.
But I think what's interesting is when you go back to the beginning of the year, what were some of the major headlines that we were looking at before inflation became as big of a headline as it is now? We're looking at Russia, Ukraine. Yeah. Okay. Well, here's the reality. What's happening in Russia and Ukraine really should not be affecting the American economy. No,
absolutely not.
To any degree. We were getting headlines, and they were negative headlines, but people were so on edge because the economy was so overinflated, and I think there was a general sense that everyone knew that the economy was overinflated, the stock market specifically, that any negative headline anywhere was going to create some volatility, because people were just kind of naturally nervous because, oh my God, we've had such a great 3 years. What's next? Everyone's worried about what's coming next. And, we got hit with Russia, Ukraine. We got hit with inflation. We got hit with the Fed raising rates. We've had a number of different things that are occurring this year. I'm not saying any of them are good by any means, but they all contributed. There was a bunch of little things that are occurring at the same time consecutively that have created a contraction in the economy that is now obviously leading into, I'm going to knock on wood, but in all likelihood, going to be officially a recession within the next couple of weeks.
And remember, we actually did a podcast on this 3 months ago when that word was being thrown around a lot. There is no that we could find official definition of what a recession is, but the commonly accepted thing is 2 consecutive quarters of negative GDP growth. Yeah. And when I say negative, that means lower than what it had been. Yeah. So
the economy is contracting.
It's contracting, right? Yeah. So you had a great point. You said that historically, 1 out of every 4 years is a down year. You've got 3 good years and 1 bad year. Well, and then we just said the last 3 years have been, I think we're correct in saying, the 3 best years for the markets in history. That tells me that 1 year that's going to correct some of that overinflation, if you will, is going to be a pretty bad year. And so far, that's what it's been. I think, and you mentioned Russia, Ukraine, and there have been a lot of other news stories that have come out in this. Those have been scapegoats. Yeah. And it's frustrating when we are told by politicians on both sides of the aisle and by news agencies, well, it's happening because of this. It was happening before those things started.
It was already happening. Right. But something like that happens, that's really not that big of a deal. Right. but it gains added importance because everyone wants to. They need something to blame. Everyone needs to blame something instead of just letting these things happen naturally. This is a natural economic cycle.
Specifically on that one, I don't want to downplay when we talk about the Russia-Ukraine situation. I don't want to downplay how horrible that is. War is hell. Absolutely. Right? That, and I feel so bad for those people. I do. But what is going on there did not cause the issues that we're having here. And I would argue it hasn't made them worse other than the public opinion being made worse because it's a scapegoat. We've been told, oh, it's because of this. These things were already going on. This is the natural reset because of things that we've done, natural growth, stimulus. We pumped way too much money into the economy over the last 2.5 years. Yeah. That's where these problems are coming from.
And I'm going to add on to something you just said, public opinion. We don't talk probably enough about public opinion as it relates to the markets. Now, not the economy. Right. The economy is going to do what it's going to do, but on the markets on kind of a short-term basis, on a daily basis, the market reacts to headlines based on public opinion or optimism and or pessimism.
Right.
And so if you have some negative headlines, whatever they may be, we're using Russia, Ukraine as an example, but it could be any number of things. It could be some jobs report that comes out that barely misses expectations or whatever. Yeah. Whatever it is, there's a tendency in the market to overreact based on public opinion, at least on a short-term basis. Now, once again, we always talk about investments as a long-term vehicle, a long-term wealth creator. And it is. It's an unprecedented. There's nothing else close to being able to create wealth over a long period of time as the stock market. That's why we do what we do. That's why we do financial planning and we make sure we're putting proper risk in place for the portfolios that we're building. But you just have to remember that everything on it. So going back to the last 3 years. So what were the markets down through the first half of 2022? I think the S&P was down 20.6% or something. It was right around 21%. Okay, well, that was
doom and gloom, horrible.
Well, that was 2021. Okay, 2021, the S&P gained about 20%.
Yeah.
Okay, great year. Now that year's been
lost that year, right?
We've lost that year from the last 6 months. Yeah. Okay, over the last 6 months. We still have all the gains. We still have
the other two.
We still have all the gains that we had in 2019 and all the gains that we had in 2020.
That's, it's amazing to me, the people that I've talked to, not necessarily clients, just people I've talked to in other groups that I'm in. Oh my gosh, everything's so horrible. Okay, let's compare this to where you were prior to, the COVID lockdowns and those 3 years that we've been talking about. Go back to prior to this. Even with all the losses, you are still most likely way up from where you were. Certainly the markets as a whole, when you look at the major indices, they are all still, even with this big downturn, way up from where they were.
I had that conversation literally yesterday in a client meeting that I had. I started working with these clients, I want to say about 3 years ago. Came in, obviously, we go through, do the review, talk about performance, obviously. And there's a lot of discussion around markets and the economy and what we think is going to happen, which is all natural. But we get to the performance part, and obviously, I asked them, "Do you want to see the number?" They said, "Yeah, that's fine." We've been looking. Yeah. We already knew what it was. So we pulled up the performance number, and I said, "Well, I want to show you one other number," because they were very like, "Oh, we've lost so much this year." Okay. Well, I zoomed out, and I think that should really be what we talk about in all of our. I'm talking about it in all of our meetings, but that really should be where we're focusing all of our energy is on zooming out and looking at the market, not just this year, but looking at the market over the last 3, 5, 10 years. Because when I zoomed out and showed them their performance over the last 3 years, they were not negative. Right. They were still very positive, and they were still in a much better position now than they were 3 years ago. There's a tendency so much to focus on what's happening right in front of us that we lose focus on what's happened over a longer amount of time. And that's what investing is. If you're investing to get a return over the next 6 months, that's not investing. That's trading.
Yeah.
If you're using in your investments to generate, create, and pass on wealth, generate income in your retirement, you have to zoom out and look at and focus on the big picture. Are your investments better than they were a decade ago?
Right.
barring something stupid you might have done along the way,
Right.
99 times out of 100, I'm going to assume that you're in a much, much better position than you were a decade ago.
You know, the best analogy to explain that I've heard, I don't remember who this was, years ago, said, look, it's very simple. If you're climbing a mountain, what you see is all those little dips that you're trying to get past, all the danger, all the rocks that are in the way. You might even see a big crevasse at some place where if you fall down in that, it's going to be bad.
Crevasse?
Right? A crevasse.
Okay.
I'm being fancy today.
Okay, you're being very fancy, yeah.
But if you back off and you look at the mountain, not from the mountain climber's point of view, but from the spectator's point of view, that crevasse is still higher up than the base. All those little dips and valleys as you go up all still lead up to that big peak. And if you think about it, the markets look like that.
Yeah.
I apologize for my fancy words.
Well, I'll be a little bit less fancy.
Okay.
I'll take a yo-yo. Take that same mountain climber. He's going up a mountain with a yo-yo.
Yeah.
The yo-yo goes up and down, up and down. All the while, the mountain climber continues to go up higher and higher on the mountain.
It's still going up higher elevation. That's right.
That's the stock market. Yeah. At some point, the yo-yo is going to be a little bit lower than it was. It's going to come back. It always comes back. If you look at the history of the stock market, and that's the only thing we can look at is history. We can't look forward. Obviously, we can guess, but your guess is as good as mine, as good as Miss Producer Whitney over there, right? And any of our clients that come in, their guess is as good as ours. Nobody knows what's going to happen. That's why we look at history. That's why we look at all of our investments in a historical context when we're putting together our portfolios. Because when you're planning, that's all that you've got to look at. But we know based on history, and we have a long period of history to look at, we will come out of this. We will rebound. Recessions are a natural, healthy part of the economic cycle.
Yeah, I would add to that, when I think of the investors who are the great investors, right, the ones who have consistently been the best investors out there, Warren Buffett's name always comes to the top of that list, right? And if you read or listen to what Buffett has said over the years, he said that the markets are emotional. They're pure emotion. There's no logic to what the markets as a whole do. So that's the reason they react and they jump around and they do all this stuff. But let's apply some intelligence, some logic to it. And that's the reason we believe in financial planning as opposed to just chasing a return.
Yeah.
If you lay things out the correct way, you know that there will be some times where the roller coaster goes up and down, or the yo-yo, or whatever analogy you want to use. But over the long term, you're being logical, and the logic will always trump the emotion if you give it enough time. My 2 cents worth.
Nope. So
I
don't know. I don't really have too much else to add on to this topic. I mean, we could certainly go on to economic analysis and all that stuff. But at the end of the day, maybe even by the time this podcast gets published, we might officially be in a quote-unquote recession. It is coming. I fully expect that the next economic reports that come out are going to show negative growth, negative GDP growth for the second quarter.
Right.
It's not a surprise to anybody. We're going to see headlines. We're going to see very negative headlines. Oh my gosh, the world is falling. We're in a recession. Right. Everyone with half a brain has known we're in a recession.
We know this is coming.
The past quarter, okay? It's coming. So very well, by the time you're listening to this, we may very well be in one. We'll come out of it. We always do. Yeah. There are even indicators that we might already be starting to come out of it. There are signs, inflation. There was another really bad inflation number that came out for the month of June. For the month of June.
Yeah, year over year for June. Yeah,
I'm forgetting we're already halfway through the year. It's scary how quickly they go now. The older you get, but we're starting to see signs of deflation, or at least disinflation, or inflation slowing. Okay, maybe it's peaked. We are seeing signs of it in the commodities market, which is usually a leading indicator of inflation. We're seeing some signs of supply chain easing up, specifically with shipping costs is definitely higher in rail and air. But it's when you're shipping goods overseas, and trucking rates are starting to come down quite dramatically as well. So there are good signs out there if you look for them. Not everything is complete doom and gloom right now. So that's why I think for the second half of the year, it's ultimately very, very important in the face of the bad economic headlines that are going to be coming out, that we stick with the plans that we've put together and stick through it.
Yeah.
You're going to be fine. But I would imagine the worst time to make rash decisions is at the bottom of a market.
That's what people did in 2008. They panicked.
And I have horror stories.
Oh, yeah.
I have so many horror stories
too.
from clients that did something back then, not when they were clients of mine, but yeah, there's so many different clients out there that made rash decisions and put themselves in a worse spot now, a decade later, if they had just sat tight and
stuck to the plan. And I think the plan is the key word. So, I'll kind of wrap up by saying this. The people that have good financial plans are not panicking. As a rule, I mean, yeah, it's natural to be worried. That's okay. If you don't have a plan, you probably are looking at the edge of a cliff right now and thinking about it, figuratively, of course.
Or at least you certainly don't feel as comfortable.
Right, you don't feel comfortable, absolutely. Yeah. If you have a good financial plan, then your investments are doing what they're designed to do. You're still on track. I had a great conversation with a client the other night that they've taken a beating. I mean, they really have. They said, "Are we still okay?" We ran the numbers and pulled them up. Yeah, they're still fine because things are positioned based on goals instead of based on return.
Yep.
Right? And that's what a financial plan is. So if you are a little bit worried, if you don't have a plan, even if you're working with somebody who says they're a planner, not everybody who says they are actually do planning work, give us a call. Ms. Producer will throw our number up there, but it's 502-200-5210. We'd love to talk about what a plan actually is, how that would impact you, how it might give you some peace of mind, and actually get you to your goals. So we'd love to talk to you. It's no charge for a consultation. Just come in and talk to us. You want to wrap things up or add to that?
No, absolutely. That's a good spot to end. So if you're listening, watching on whatever device or whatever platform you might be using, please, leave us a rating, leave us a review. We greatly appreciate it. If you can share our content with anybody that you feel might benefit from anything that we have to say, that would be fantastic as well. And once again, if you have any questions or would like a second opinion on anything, please don't hesitate to give us a call, 502-200-5210. Thanks for watching. Thanks for listening. Until next time.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.